We have a chart here, if you want to take a look at the Bloomberg terminal, showing that Fed officials are absolutely not concerned about downside risks to inflation anymore. Yes. And this is part of what's feeding into the decision to raise rates more rapidly. Do you think that they're right, that there is no downside risk to inflation? And if not, is the market accurately pricing in inflation right now?
No. There's always downside risk to inflation because there's shock potential. But under their base case, I think I would agree with them that there is a lot more upside than downside risk to inflation, and that you might be at a more sustainable 2% core, which is the number we just hit yesterday. So when you think about it in the context of 2% core inflation and a 4% unemployment rate, and let's just project out a year, are we going to be at 2% core and a 3.6% unemployment rate a year from now? And if we are, does 2.5% endpoint on Fed funds rate that investors are pricing in make any sense? Probably not. The Fed is closer to 3.5%, which means that short end is coming up, which means short rates are attractive relative to equities, which now have more risk associated with them, which means an above normal median PE probably makes a little less sense. So we're at 16.5. 15 is the normal going back to 1990.
So, Mike, take me through this because you follow so closely. I understand that if the interest rate goes up, then the value of the stock in some sense goes down because you use a discount rate that's different, higher discount rate. But we're talking about the difference between 1.5% and 2%. It's not like 3% and 5%. Is raising it 0.5% really going to have that much effect on the discounting of the future earnings of a company?
In a larger sense, no. But in the sense that we have not had this for 10 years now, it does make an impact, and especially with yields across the board in almost all asset classes so low for so long, it does have an effect on what people are projecting they can earn. So it has an impact. One of the questions is how far does the Fed go now with inflation rising? And it's going to be very interesting in the statement tomorrow to see how they describe the inflation environment. They've been saying in their statements, we expect to get to 2%. All right, we're there. So do they talk about going beyond that a little bit? And some of the members of the Open Market Committee have suggested that would be okay. How does that affect the markets? And do they push rates up farther, faster, especially at the short end? And then on top of that, throw in Treasury. And the fact that you're going to have the refunding announcements, and Treasury, in theory, is going to be concentrating at the shorter end. And then you get this recipe for an even flatter yield curve and that impact on the markets as well.